Thank you so much for your time today, Joshua. And let's first start with how we've seen the market play out this week and how investors have been looking at those banking stocks.
Well, thank you for having me. I think what we've seen generally is a little bit of a back and forth. There have been a couple of positive sessions, especially on the banking side, but generally I think the sentiment is still a bit bearish, simply due to the fact that investors, I believe, think that they can get better options in the fixed income market because yields are much higher now.
Yeah, because looking at the year-to-date performance of the banks, as a close of market last week, it was down about 4%, and I'm still trying to track how it's closing this week. But for you, how do you see the estimations going into the full year?
By the end of the year, specifically for the banking sector, unfortunately, I think that we may be seeing a bit of a negative close, a bit of a red close, just due to the fact that although the banks themselves are going to probably perform better year on year, general sentiment towards the entire market is skewed towards the negative.
All right, man, but let's look at those half-year numbers and what are they telling us, especially in terms of profitability and also some of the key ratios that you're tracking.
Right. Well, so what we've seen so far from the few banks that have released half-year results have been quite positive. I mean, even First Bank, although there was a bit of a dip between Q1 and Q2, we still saw that they've grown year on year. We saw that as well with a couple of the other Tier 2 banks that have released so far. We're still waiting to see a much grander picture by the time we see all the Tier 1s, your GTs and your Zeniths and the rest. But I think the general consensus is that there's still going to be more growth.
Yeah, but when you see what we see in terms of like interest income?
Well, okay, so there's two sides to it. On the one hand, from loans and advances, there hasn't been that much growth. We know that, first of all, the banks are not giving out loans at the same rate that they were a year or two ago. And at the same time, we've seen that yields in the fixed income space have gone up. So there's been a lot more activity there. And we can start to expect that the yields that the banks are going to get on their fixed income securities are going to inch up. And so I think we're going to see more of that actually in H2 with regards to yields from fixed income securities. But interest income from loans and advances is going to be pretty much stable.
Yeah, because we've seen quite a lot of headwinds when you look at the first half of the year.
Right.
And in how the banks are responding to some of these challenges, and more or less, I'd like to get what your assessment is of the environment in the first year and more or less how banks have positioned to address these challenges.
Well, I mean, okay, so a few of them, when you talk about high inflation and the fact that the CBN has now raised rates twice this year, this presents a bit of an opportunity for the banks if they had positioned themselves, looking at the way the global landscape was going and how inflation was rising quite rapidly in the West and how those central banks responded to that. They could have maybe anticipated that there may be some rate hikes which would come about due to the fact that we have such high inflation. Now, if they had done that, then they would be in a good position to take advantage of the rising yields and also would start to see more patronage from investors when it comes to fixed income trading, which I think has been the case. And we saw a little bit of that as well in the Q2 results, where there was a much higher jump in fixed income trading revenue.
But when you look at the banking sector in Nigeria as a whole, are you noticing any key trends across the tiers?
Well, yeah, to a certain extent, you can see that obviously there's been a concerted effort to focus on the non-interest revenue to a large extent to sort of shore up, because it's a very easy way to raise your bottom line if you have significant fees and commissions, trading revenue, and things like that. And so I think we've seen a little bit of that across Tier 1 and Tier 2. But obviously the Tier 1 banks have sort of taken a different approach, which is the holdco structure and all. But the Tier 2s are still doing a lot of things with regards to things like digital banking, USSD,
yes,
trying to push that quite significantly. And then agency banking, we've seen a lot of growth in that space specifically.
Because I asked that question because I was going to go into this area around talking about how they are positioning to compete or more or less collaborate in that space. Right. We're seeing the fintechs come on board, doing quite a lot in that space in terms of financial services. Right. And now we're also seeing that telco-led push from the payment service banks as well.
Right. That's just going to be a lot of competition. Hopefully for the customers, for the consumers, that should be positive. It should lead to better service. But for them, it should also create a lot more innovation. So they are going to have to be very, very creative with the way they structure their fees, because the PSBs, like you mentioned, are much cheaper to transact with than the traditional banks. So they're going to have to find a way to cut their costs or just lower their fees. And that's going to create a much more diverse area or selection for customers. But I think that that's always just a positive.
Yeah, but when you look at the down the line, what downside risks do you see, especially for the banking sector, for the rest of the year?
For the rest of the year, well, so the thing is, it's all tied to the economy, right? So if economic growth slows down or, heaven forbid, turns negative, that will start to trickle into things like your non-performing loans. You might start to see things like provisions increasing, and at the same time, this could have a negative effect on loans and advances and the like. So there are a few ways that it could impact, both in terms of income and in terms of costs. And those could potentially, if the economy goes bad, could have some sort of downside risk.
Yeah, because now when you look at the banks and in terms of the risk, currency risks, for example, and you look at banks who are positioning to be more Pan-African in nature, you know, how is that impacting them? Especially players like EcoBank.
Well, for them, it's only a positive, simply due to the fact that the more diverse and the more markets you are in, the less specific currency risk you have from one country. So if Nigeria is going through a bit of a bad patch as it is at the moment, but you have a lot of exposures outside of that and you're a bit long on your balance sheet, you may be able to cover those short-term revaluation losses. And the more income you're having from those other countries, the better your balance sheet looks overall, and the better your income will look, and you have less risk. So I think that all those banks, like you mentioned, EcoBank, UBA, Access Bank, all those banks are definitely spreading their risk quite well, and they should be a little bit insulated from too much currency devaluation risk.
Finally, one word, your outlook for monetary policy.
Monetary policy, up.
All right, then thank you so much, Joshua Odebisi, the banking analyst at Vetiva Capital.